As we move further into 2024, one thing that will be dominating the headlines will be this year's presidential election. For this monthly minute, I'm going to spend some time reviewing how elections have historically affected the stock market. Dating back to the 1924 election, the S&P 500 has generated positive returns in 20 out of 24 election years, or 83% of the time, and it has an average return of 11.5% in those years. That comes in higher than the average return of 9.81% for all years since 1928. So, what does this exactly look like? The stock market has averaged positive returns in all 4 quarters of election years over this time period. However, election years typically start off sluggish, with performance picking up in the second half as the results of the election are more certain. Another thing to note is that volatility tends to be higher in election years. This is something that can scare investors, but the main thing to remember is that this volatility typically fades after the election cycle is complete. Now, it's still early in the year, but it's important to keep your financial goals in mind as news surrounding the election becomes more prevalent. Avoid making any major portfolio decisions based on election predictions, and try not to let short-term volatility affect your decision making.